Hi, everyone, and welcome back to the Nick Hilaire Show. Okay, America probably was pretty stratified going into at least from a wealth and income perspective, pretty stratified going into the GFC, and it obviously stepped up after. And one of the things I sort of understand at an intuitive level, but never quite got it like in depth that I've been curious to understand is how does QE itself exacerbate the wealth inequality problem? Like the actual mechanism of QE, right? Like the Fed prints money, they go and they buy bonds from the banks. Like, how do you see that liquidity resulting in what we've seen? Like the data is pretty obvious. Like when QE is happening, wealth inequality goes up. But I'd love to understand a little bit more about the plumbing of it.
Yeah, so we really have to look at QE and interest rates at the same time. They're working together. They're worked together,
Okay.
and so interest rates being the policy rates being down to zero gave people that have access to these policy rates free money. And that happened through like borrowing in the repo market. And the repo market is the largest short-term borrowing market in the United States. It's $4 or $5 trillion a day that get exchanged there. And the repo rates back then were very close to the Federal Reserve's policy rates, which were just a hair above 0%. So people could borrow short-term in the repo market and and then buy long-term assets with it. So if you have essentially no cost in your capital, it really doesn't matter how much you pay for something, and you buy real estate and you buy stocks, and you buy companies, and so that drove up asset prices, and holders of these assets became wealthier because those asset prices went up. And that's across the board. So that's stocks and it's real estate and it's housing and it's just everything all the way through. And during that time, Bitcoin came out. This is 2009. So it was kind of a reaction to that, and it benefited from it probably as much as anything. And because people were buying Bitcoin, and just like they were buying everything else, and so that's the interest rate part. And then there is the QE part, which so interest rates are the policy rates are short-term interest rates. The Fed sets the short-term interest rates, and that doesn't impact necessarily long-term interest, so like a 10-year, a 30-year bond or a mortgage. And those rates are more impacted by QE. So QE is when the Fed um, creates money. So money is a credit. It's not anything you can touch. It's a credit in the banking system, and so it creates this credit and puts it in the bank's account at the Fed, and then the banks have this, and and they buy something with it, and so the Fed would buy, for example, $10 trillion worth of government treasury securities from a bank. So the bank would get $10 billion in these credits and would deliver those treasury securities to the Fed. And then the bank can use those $10 billion to buy something else. You buy stocks or buy other treasury securities. And so you do that spread across trillions of dollars, and you get a surge of demand for financial assets. And there's all this liquidity chasing financial assets. So interest rates are yield. So how much you can earn on your assets, that has plunged. So you buy a 10-year bond, and by then the interest rate was 2% or something in 2009, or 1.5%, and in 2020, the 10-year bond in August 2020, during the big QE wave at that time, the yield on the 10-year bond, a 10-year note was 0.5%. And so you couldn't really earn anything. That the prices were so high that the yields were really low. And so there was this chase for yield. That these investors would try to buy whatever they get their hands on to get some yield, and it drove yields down further, and it drove asset prices up. So when one thing we have to remember with fixed assets on real estate, that with bonds is the same thing. A higher price generates a lower yield. So if you overpay for something, you have a bond that pays 5% yield on $1,000 bond, you get $50 in interest. Now, if you bid up that bond to $2,000, you still get $50 in interest a year, but now that's 2.5% of $2,000. So your yield dropped to 2.5% because the asset prices was driven up. That happened in financial instruments. That happened in real estate. So prices ballooned, yields went down, cap rates went down, and it created a lot of wealth and in with people that owned these assets. And we're talking many, many trillions of dollars. There's back then there was $15 trillion in the stock market and $15 trillion in the treasury market, and there was corporate bonds and municipal bonds and money market funds. I mean, there's huge. The amounts are huge, and they were, all these assets are owned. So when the asset prices went up, the people who owned them became very wealthy. And the Federal Reserve itself tracks the wealth distribution, and I've covered that occasionally. And you can see that how when quantitative easing and interest rate repression, as I call it, set in, how the wealth of the wealthiest just ballooned, just took off, woof, and multiplying. And the wealth of the people that don't really have any assets, that are working for a living, and they may have a car, and they may have some some things at the house, and they may own a little bit of real estate. Their wealth didn't really change much, and they just had to pay more for everything. And so quantitative easing threw all this money in it, and along with interest rate repression, you got this huge amount of chasing after assets that drove up asset prices. And since it stopped, it really hasn't gone anywhere. Real estate hasn't across the nation. Real estate prices and housing has kind of flattened out. In some parts, it's come down a lot. In some parts, gone up. Commercial real estate is in trouble. Stocks are, they reached a new high, but the old high was 2 years ago, and they're not much above that. And the Nasdaq hasn't reached a new high yet, so it's really leveled off since this QE ended, and so you can see that. And I think there's an understanding at the Fed that cannot really keep doing QE. It just, number one, now we have inflation, and it's not going away very easily. And number two, you cannot keep making the wealthy even wealthier. You just can't do that. You're going to completely blow up the system if you do.